In today's video we will be talking about investing for beginners. Before we move on, don't forget to subscribe and click the bell icon. Investing may seem intimidating, but it's actually a great way to grow your wealth over time. Whether you're saving for retirement, buying a home, or just looking to increase your net worth, investing is a great way to achieve your financial goals. However, getting started can be overwhelming, especially if you're new to the world of investing. There's so much to learn, from choosing the right stocks and bonds to understanding market trends and investment options. But don't worry, this guide will cover everything you need to know to get started with investing, even if you're a complete beginner. By the end of this post, you'll have a better understanding of how investing works, why it's important, and how to get started with your own investment portfolio. Why investing is important for financial success. Investing is a crucial component of achieving financial success. While saving money is important, simply keeping your funds in a bank account may not be enough to generate significant wealth. The power of investing lies in the potential to grow your money over time by putting it to work in various investment vehicles such as stocks, bonds, real estate, and mutual funds. One of the key reasons why investing is important is the potential for long-term wealth accumulation. By investing your money wisely, you have the opportunity to generate returns that surpass the rate of inflation, allowing your wealth to grow and maintain its value over time. This is especially critical considering that the purchasing power of money tends to diminish over the years due to inflation. Understanding the basic concepts of investing. When it comes to investing, understanding the basic concepts is crucial for beginners. Investing can seem like a complex and intimidating world, but with a solid grasp of the fundamentals, you can navigate it with confidence. First and foremost, it's important to understand the concept of risk and return. Investments typically involve some level of risk, and higher potential returns often come with higher levels of risk. It's essential to assess your risk tolerance and financial goals before diving into any investment strategy. Another key concept is diversification. Diversifying your investment portfolio means spreading your investments across different asset classes, such as stocks, bonds, and real estate. This helps to mitigate risk and increase the potential for long-term growth. Next, let's talk about compounding. Compounding is the process of reinvesting your investment earnings to generate additional returns over time. By reinvesting your earnings, you can take advantage of the power of compounding and watch your investments grow exponentially. Furthermore, it's important to understand the difference between active and passive investing. Active investing involves actively selecting and managing individual investments in an attempt to outperform the market. On the other hand, passive investing involves investing in index funds or exchange-traded funds. Setting your investment goals. Setting clear investment goals is a crucial step in your journey to becoming a successful investor. Without a clear direction, it's easy to get lost in the vast landscape of investment options and strategies. So, before diving into the world of investing, take the time to define your goals. Start by asking yourself what you hope to achieve through your investments. Are you looking to grow your wealth over the long term? Are you saving for a specific milestone, such as purchasing a home or funding your child's education? Or perhaps you're aiming for financial independence and early retirement. Once you have a clear understanding of your goals, it's essential to set specific, measurable, achievable, relevant, and time-bound, SMART targets. For example, instead of saying, "I want to make a lot of money from my investments," a SMART goal would be, "I aim to achieve a 10% annual return on my investment portfolio over the next 5 years." Common mistakes to avoid as a beginner investor. As a beginner investor, it's important to be aware of common mistakes that can hinder your progress and potentially lead to financial losses. By learning from the experiences of others, you can navigate the investment landscape more confidently. Here are some common mistakes to avoid. Number 1. Lack of research. One of the biggest mistakes beginners make is diving into investments without conducting thorough research. It's crucial to understand the fundamentals of the investment vehicle you're considering, such as stocks, bonds, or mutual funds. Take the time to educate yourself and seek advice from reliable sources before making any investment decisions. Number 2. Emotional decision-making. Allowing emotions to drive investment decisions can be detrimental. Fear and greed often lead to impulsive actions, causing investors to buy or sell based on short-term market fluctuations. Instead, focus on long-term goals and stick to your investment strategy, even during periods of volatility. Number 3. Putting all eggs in one basket. Diversification is key to managing risk in your investment portfolio. Don't put all your money into a single investment or a single asset class. Spread your investments across different sectors, industries, and asset classes to mitigate potential losses. Creating a budget to allocate funds for investing. Creating a budget is a crucial step in getting started with investing. Before you dive into the world of stocks, bonds, or real estate, it's essential to have a clear understanding of your financial situation and goals. A well-planned budget will not only help you allocate funds for investing but also ensure that you have enough income to cover your daily expenses and emergencies. To begin, take a comprehensive look at your income and expenses. Calculate your monthly income from all sources and list out your necessary expenses such as rent, utilities, groceries, and transportation. Next, analyze your discretionary spending, which includes entertainment, dining out, and non-essential purchases. This step will help you identify areas where you can potentially cut back and redirect those funds toward investing. Once you have a clear picture of your financial obligations and discretionary spending, it's time to determine how much you can comfortably set aside for investing. Financial experts often recommend setting aside a certain percentage of your income for investments. This percentage may vary based on your financial goals, risk tolerance, and time horizon. Remember, investing is a long-term commitment and should not compromise your ability to meet your immediate financial needs. It's important to strike a balance between saving for the future and maintaining a healthy financial cushion for unexpected expenses. Additionally, consider creating an emergency fund before you start investing. This fund should cover at least 3 to 6 months of living expenses and serve as a safety net in case of job loss, medical emergencies, or other unforeseen circumstances. As you allocate funds for investing, it's advisable to diversify your portfolio. Investing in different asset classes, such as stocks, bonds, and mutual funds, can help spread the risk and potentially increase your returns. We hope you found our ultimate guide to getting started with investing to be informative and helpful. Investing can seem intimidating, but with the knowledge and strategies outlined in this blog post, you can confidently take your first steps toward financial growth. Thanks for watching. Don't forget to subscribe, like, share, and click notification bell to get notified for our next video about your financial health.